Hey folks, welcome everyone. I hope you're doing fine. I'm Simo from Investment Research and it's Monday, December 8th, 2025. The market is open now and I need to talk about SoFi because my Sunday analysis is playing out exactly as I predicted and there's some really important trading opportunities developing right now. So here are the 3 questions I'm going to answer for you today. Did my Sunday forecast come true? And what does that tell us about the next move? What are the institutions actually doing with this stock based on the latest 13F filings? And should we follow the smart money? And most importantly, is this the buy the dip moment we've been waiting for, or should we still be patient? Let me start with confirmation of what I told you yesterday, because credibility matters to me, and I want you to know that my analysis is based on real technical and fundamental work, not just guessing. On Sunday, I predicted that SoFi would open weak on Monday, possibly gap down to the $27 to $27.25 range because the offering was closing today and 54.5 million new shares would hit the market. So what happened? Actually, the company is trading at $27.15 to $27.61 in pre-market right now, and we opened right at $27.73. That's exactly what I called. The stock is down about 0.5% to 0.7% from Friday's close of 27.78. Now, from what I believe, this confirmation is critical because it shows that the technical analysis and the offering dynamics I explained on Sunday were accurate. And so what does this mean for the rest of today and this week? It means we're right at the offering price of $27.50 and this level is going to act like a magnet. Stocks often gravitate toward their offering prices in the days immediately after a capital raise because that's where the new shareholders bought in and they're not going to sell below their cost basis easily. So the big question for today is, do we hold $27.50 or do we break it? If we hold this level through today's session and close above $27.50, I think we've found our bottom for now, and we could see a bounce back toward $28.50 to $29 over the next few days. But if we break $27.50 with conviction and volume, then my next target is $26.50 to $27 and potentially $25 to $26 by the end of the week. That's the critical decision point we're at right now. Let me talk about what the institutions are doing because this is where it gets really interesting, and I spent hours over the weekend digging through the 13F filings from MarketBeat and SEC data. So here's what the smart money is doing. According to the latest filings, there are 1,242 institutional owners holding a total of 673.6 million shares of SoFi. That represents about 53% institutional ownership. So more than half of SoFi's shares are held by institutions, not retail investors. Now the top holders are exactly who you'd expect. Vanguard owns 8.3% of the company, BlackRock owns 5.4%, and JP Morgan owns 4.1%. These are the massive index funds that have to own SoFi because it's in their benchmark indices. But what's more interesting to me is what the hedge funds and active managers are doing because they're the ones making active buy and sell decisions based on their view of the business. And so here's what caught my attention. Jump Financial, which is a quantitative hedge fund, increased their stake by over 1,000% in Q2 2025 to 2.27 million shares. That's a massive vote of confidence. Creative One Wealth increased their position by 120%. Legal & General and Vinva Investment Management also added to their positions recently. So there are smart institutional players who are buying SoFi, not selling even after this dilution announcement. But here's the other side of the coin, and I need to be honest with you about this. Hedge funds and institutions control about 38.4% of the float, and the overall institutional ownership has been relatively stable. We're not seeing a massive influx of new institutional money. What we're seeing is some funds increasing, some decreasing, and most holding steady. That tells me institutions are cautiously optimistic but not aggressively buying. From what I believe, the institutional data is neutral to slightly bullish. The fact that Vanguard, BlackRock, and JP Morgan own over 17% combined is reassuring because these funds don't hold junk. But the fact that we're not seeing a flood of new institutional buyers tells me the smart money is waiting for more proof that the $1.5 billion will be deployed effectively. Now, let me talk about the financial analysis because I want you to understand the numbers, not just the stock price. So this company is trading at a market cap of about $33 billion right now at $27.50. With the new shares from the offering, we're looking at roughly 1.25 billion shares outstanding. So that gives us about $26.40 in market cap per share. The company did $961.6 million in revenue in Q3, which annualizes to about $3.8 to $3.9 billion for the full year 2025. So we're paying about 8.5 times sales for SoFi. Is that expensive? It depends. Compare that to Chime, which went public in June 2025 and is trading at about 6 times sales. Compare that to Robinhood, which trades at about 7 times sales. And compare that to traditional banks like JP Morgan, which trades at about 3 times sales. So SoFi is more expensive than most of its peers on a price to sales basis. But SoFi is also growing faster. Revenue grew 38% year over year in Q3, while JP Morgan grew at about 8%. So you're paying a premium for growth, and the question is whether that premium is justified. Let me break down the earnings picture because this matters for valuation. SoFi is targeting full year adjusted EPS of about 0.27 to 0.28 for 2025. With the new dilution, that number might come down slightly to 0.26 to 0.27 because we have more shares outstanding now. So at 27.50, we're paying about 100 times trailing earnings and about 50 to 54 times forward earnings based on 2026 estimates of 0.52 to 0.55 per share. That's expensive, and I'm not going to sugarcoat it. You're paying 50 times what the company is expected to earn next year. But here's the bull case, and I want to be fair about this. If SoFi can sustain 30% to 40% revenue growth for the next 3 years, and if they can expand operating margins from the current 5.8% back up to 10% or higher, then earnings could grow at 50% to 60% annually. In that scenario, you're paying 50 times this year's earnings, but only 15 to 20 times 2027 earnings. That's the growth math that bulls are betting on. The question is, do you believe they can execute? From what I believe, SoFi has a path to justifying this valuation, but it's a narrow path. They need to execute flawlessly on member growth. They need to cross-sell more products per member. They need to expand margins, and they need the crypto and international expansion strategies to work. That's a lot of ifs. And so the risk reward at 27.50 is not compelling unless you have very high conviction in management's ability to execute. Now let me address the trading opportunity because I know some of you are looking at this and thinking, is this the buy the dip moment? So here's my honest take. At 27.50 right now, this is not yet a screaming buy. We're right at the offering price, which acts as support, but we haven't confirmed that support is going to hold. The volume in pre-market is only about 48,000 shares, which is modest. I need to see how we trade in the first hour of the regular session. If we hold 27.50 through the first hour and start moving higher on increasing volume, then yes, I think 27.50 to 27.75 becomes a decent entry point for a swing trade. Your stop loss would be at $26.75 and your target would be $29 to $30. That's about 7% to 10% upside with 3% downside risk. That's a 2.5 to 3 to 1 risk reward ratio, which is tradable. But if we break $27.50 in the first hour and start heading down to $27 or below, then I'd say wait. The better buy, the dip opportunity will come at $26 to $26.50, or even better, at $25 to $25.50. At $25, you're buying near Wall Street's consensus price target of $24.88, and you're getting a 10% discount from Friday's close. That's a much better risk-reward setup. So here's my trading strategy for the next 48 hours. Strategy 1, if you're aggressive and you want to catch a potential bounce, you can buy a small position at $27.50 to $27.75 today with a tight stop at $26.75. This is a speculative trade betting that the offering price holds and we get a relief rally. Strategy 2, if you're patient and disciplined, you wait. You watch to see if we break $27.50, and if we do, you wait for $26 to $26.50 to start scaling in. This is the safer play with better risk reward. And strategy 3, if you already own shares and you're sitting on gains, you do nothing today. You hold through this volatility, but if we bounce back to $29 to $30 over the next week or two, you trim 20% to 30% of your position and lock in profits. Don't get greedy. The stock is still up 77% year to date, even after the sell-off. Protect your gains. Let me talk about the institutional concentration because this is important for understanding supply and demand dynamics. With Vanguard, BlackRock and JP Morgan owning over 17% combined, and with total institutional ownership at 53%, that means about 47% of the stock is held by retail investors. Retail tends to be more emotional and more likely to panic sell. So when you see a 6% drop like we had on Friday, a lot of that selling pressure is coming from retail, not institutions. The institutions are long-term holders who are less likely to sell on short-term news. And so from what I believe, the fact that institutions own 53% is actually stabilizing for the stock. It creates a floor because these big funds aren't going to dump shares at $27. They're thinking about where SoFi will be in 12 to 24 months, not 12 to 24 hours. But here's the flip side, and I need to be honest about this. When institutions want to get out, they don't just hit the sell button, they distribute slowly over weeks or months to avoid moving the price. So the fact that institutional ownership is stable doesn't mean they're not quietly reducing positions. We won't know for sure until the next round of 13 F filings come out for Q4. Now, let me give you some context on what's happening in the broader fintech sector because SoFi doesn't trade in a vacuum. Robinhood is up about 15% year to date. PayPal is flat to slightly down. Square, now Block, is down about 10%. Affirm is down about 20%. So the fintech sector overall has been mixed in 2025, and this company had 77% gain year to date, actually makes it one of the best performers in the space. That's important context because it tells you that even after this pullback, SoFi has massively outperformed most of its peers. From what I believe, the sector rotation we're seeing is investors moving away from unprofitable growth fintechs toward profitable scaled fintechs. SoFi benefits from that because they're now GAAP profitable for 8 consecutive quarters. But the dilution and the capital raise create questions about whether profitability is sustainable, and that's why we're seeing this sell-off. Let me address one more thing before I give you my final call, and that's the cash flow situation. SoFi generated $139.4 million in net income in Q3. Annualized, that's about $550 to $600 million in annual net income. But the company just raised $1.5 billion. So they're raising capital that's equivalent to about 2.5 years of net income. That's a lot. Either they're planning massive growth investments that will take years to pay off, or they're seeing cash flow pressures that aren't obvious in the income statement. I looked at the cash flow statement from Q3, and here's what I found. Operating cash flow was positive at $207 million in Q3. That's good. But free cash flow, which is operating cash flow minus capital expenditures, was lower at about $150 million. So on a run rate basis, SoFi is generating maybe $600 to $700 million in annual free cash flow. If that's the case, why do they need $1.5 billion in fresh capital? The math doesn't add up unless they're planning to deploy capital much faster than their current free cash flow generation. From what I believe, and this is speculative, SoFi is probably planning to accelerate loan originations, expand the crypto platform, build out international remittances, and potentially make acquisitions. All of those are capital intensive. And so the $1.5 billion gives them the flexibility to move fast without being constrained by internal cash generation. That's the optimistic interpretation. The pessimistic interpretation is that credit losses are mounting faster than expected and they need a buffer. We won't know which one is true until the Q4 earnings call on January 26th. So let me give you my final call for today, December 8th, 2025. SoFi at $27.50 is a hold with a cautiously bullish lean for a short-term bounce. I think we have a decent chance of holding the offering price and getting a relief rally back to $28.50 to $29 over the next few days. But I'm not putting a lot of capital to work here because the risk reward is not screaming at me. If you want to take a small speculative position at $27.50 with a tight stop at $26.75, I think that's defensible for a swing trade. But for long-term investors, my advice is still to wait. If you don't own SoFi, wait for $25 to $26 to start building a position. If you already own it, hold through this volatility and trim on strength at $29 to $30. Don't panic sell here, but don't add aggressively either. This is a patience game. My price target for the next 2 weeks is $28 to $29 if we hold $27.50 or $25 to $26 if we break it. My conviction rating is 5 out of 10, neutral. I'm not bearish enough to short it, and I'm not bullish enough to load up. I'm watching, waiting, and ready to act when I see a better setup. And here's what I'm watching for the rest of this week. Monday and Tuesday, I'm watching to see if $27.50 holds. If it does, I expect a bounce toward $28.50. Wednesday, I'm watching for any news on S&P 500 inclusion or analyst upgrades. That could be the catalyst for a bigger move. Thursday and Friday, I'm watching to see if we can reclaim 20 nows. If we do, the technical picture improves significantly. But if we break $27 this week, I'm stepping back and waiting for $25. One last thing before I wrap up. The institutional data tells me that smart money is not panicking, and that's reassuring, but they're also not aggressively buying, and that tells me they're waiting for more clarity. So I'm taking the same approach. I'm waiting for more clarity on how the $1.5 billion will be deployed. I'm waiting for Q4 earnings to confirm that fundamentals are still strong, and I'm waiting for a better entry point from a risk-reward perspective. Stay disciplined out there. Don't let emotions drive your trading. And remember that the best trade is often the one you don't make. Patience pays in this market, especially when you're dealing with a stock that's up 77% year to date and just got hit with 10% dilution. Let the dust settle, let the stock find its level, and then make your move with conviction. I've shared today is my personal analysis and opinion base, and you must do your own research. Read SoFi's SEC filings, study the 13F institutional holdings, understand the business model, understand the risks. To make your own informed decisions, take full responsibility for your own portfolio. Thanks for watching, and I'll see you tomorrow with another update on how SoFi trades through this critical $27.50 level. Stay safe out there.